Such a pleasure to be joining you back right here on the India Development Debate. I'm Supriya Srinath, and we are going to put the spotlight on inflation, IIP, and what should the commensurate monetary policy action be? Has the stage been set for an RBI rate cut? How is this going to help? Will it rev up investments and consumption? Many questions that I'm going to put forward to an expert panel that's joining me right here. And of course, joining me on the show this evening are four very, very special guests. I've been joined by Nilesh Shah. Of course, Shaugato Bhattacharya also joins us. So does Pradeep Chaudhary and Mr. R. Nagaraj. So thank you each one of you for being with us. Can't thank you enough for taking time out. Nilesh, let me begin with you. The December CPI stood at 2.19%. That's the lowest since July of 2017. Wholesale price inflation also decelerated to an 8-month low of 3.8%. You know, on the back of softening inflation for fuel as well as manufacturing prices, do you believe the stage has been set for an RBI rate cut, especially given the softening that one has seen in the latest reading of the factory output data?
The market will be considering a couple of factors. However, they are optimistic about change in stance as well as a potential rate cut. One, the inflation number, as you mentioned, has been consistently falling for last 6 months. The average of last 5 months inflation is just about 3%, and the 10-year yield on the old benchmark is at 7.47%, giving a real return of 4%, which is very, very high. RBI probably will keep a watch on fiscal deficit, and since the next credit policy will be after the budget, if the budget gives assurance on fiscal discipline side, then there is a reasonably good chance that RBI can consider a rate cut.
No, I understand, and I think you're bang on when you say that the budget reading is going to be an important one there. I will come to the budget reading in just a bit, but let me quickly get Shaugato Bhattacharya and also Pradeep Chaudhary on both. And Shaugato, I think, you know, the inflation reading is making a lot of people suggest that, you know, the stage is set for an RBI rate cut and there may be one very soon, you know, on the Feb 7th policy. But remember, the Feb 7th policy also follows the union budget, and the commentary on the fiscal profligacy and all of that is going to be a very crucial input into policy making then. How are the scales going to sort of weigh as far as the fiscal commentary and everything is concerned vis-a-vis the hard numbers that are on the table?
So, thank you, Supriya. A couple of points. I completely agree with Nilesh Bhai that I personally think that the stage is now right for a rate cut. But I'm not very sure whether the MPC, when it meets in early February, will take the similar view. I think it's very, very likely that they will change the stance back from calibrated tightening back to neutral. So that is going to happen. The union budget, to my mind, will display a sense of fiscal prudence. I don't think they will bust the 3.3 FY19 target by too much. Maybe a 1 basis point or so, 3.4, not too much. But I think what they will need to consider, and they will consider, are the state fisc. I think that's something which is will be of greater concern to the MPC. That's what they will put out in the statement. Going beyond that, I don't think there will be an immediate rate cut at this point in time, because they will probably wait for the March meeting of the Federal Reserve, which is a very important meeting. In terms of the Fed FOMC stating what their stance is likely to be going forward. There's been a significant fear of global financial markets. But having said this, I think the track of inflation that we see in FY20, which will average about 3.8, 3.9%, I think gives them room for a rate cut, and particularly presuming that growth is not going to be very strong.
No, fair point indeed. Just hold that thought there, because I want to get in Professor R. Nagaraj into this discussion, and then Pradeep Chaudhary. And Professor Nagaraj, you know, unlike what a lot of people they believe, because inflation has shown a downward reading and because IIP has slumped, the stage is set for a rate cut. The reality is that there are too many things that go into a decision that the MPC is likely to take on the 7th of February. Of course, one such thing is hard data. and it's a data-driven decision. But the other part of it is, what is the government and the budget going to say on the fiscal front? And the third and a very important part of it is, what is it that the Federal Reserve will do? And when we talk about a rate cut, we sometimes, I think, lose, let the conversation be mired by the noises. So I think it's only fair that we put all those points into consideration. Professor Nagraj, just to quote the RBI monetary policy of December, and it had very categorically said that if upside risk to inflation wane, and if the upside risk flagged by the MPC don't materialize, then possibility of space opening up for commensurate policy action could be looked at. Do you believe that space has opened up?
Yeah, thank you. Yes, I think the space has opened up with the recent data which we have got. As other speakers said, the inflation has moderated further. Industrial production has come down. GDP numbers don't look too good. So all this suggests that the real sector of the economy is not doing too well, and therefore there is if there is a rate cut, it can stimulate economic activity, and if you don't do it, then I think the real interest rate for investment goes up, and therefore that's a danger. If the real interest rate goes up, then investment activity will get affected. So I think there is room for rate cut in the near future. Yes, the Federal Reserve's next meeting decision is important, but as Federal Reserve has, the Federal Reserve Chair has recently hinted, I think they are likely to be more cautious in increasing the rate because the world economy doesn't look too good, and even the US economy has not been doing too well lately. There are concerns about deceleration. So given all that, I think we should not worry immediately about the Fed reaction, but looking at the domestic considerations, I think there seems to be room for a rate cut.
Professor Nagraj, give me a minute there, because I want to take this discussion to the impact of what a rate cut will do. And Pradeep Chaudhary is here with us. And Mr. Chaudhary, this debate is happening at a time when not just Indian growth but global growth has decelerated. There are obviously fresh concerns, like everybody has pointed out there. I think Professor Nagraj really put that the US growth is waning as well, and many people believe that growth globally has kind of peaked out. There are also liquidity concerns that remain. How much of a role do you believe a rate cut would play in reviving consumption and private investment? If numbers are to be believed, then private consumption is expected to fall from 7.3 in fiscal year 17 to 6.4 in fiscal year 19. According to the advanced estimates, of course, I'm really quoting numbers from there. Will this be a big driver in terms of driving up and revving up consumption and also pulling in private investment?
No, consumption and private investment both need to go up, because right now they are anemic. And my question is that if you don't do a rate cut now, then when? Because RBI has always been saying we want to see benign inflation, we want to see inflation expectations low. So you have all of that. Inflation is down to 2.7, and if inflation has a direct correlation with the crude prices, even crude prices in the immediate term look quite soft. And this talk about, following the US, what is the US 10-year rate? US 10-year rate is 2.7, and what is our rate is 7.5. So there is already a difference of 400 basis point in the 10-year rate if you take that the benchmark. So Indian industry is suffering due to differential in interest rates. So therefore, I think US comparison we are making, but when US did an expansion, when they did an asset purchase, we were never enthused by it. So whenever their contraction steps are there, we feel encouraged. Now, I think the patient has been waiting under anesthesia for too long. It's time the surgeon took out the scalpel and started the surgery. And I would even recommend a CRR cut, because along with the cost, the availability is also an issue. So therefore, a CRR cut, to my mind, is the most non-discriminatory way of transmitting liquidity in the system.
Right. We put forward these questions to the RBI and its board members last time around, and they said that CRR should be used in the very, very rare circumstances. There are enough liquidity boosting tools. Why look at CRR? But give me a minute. I'll take this across to Nilesh. Nilesh, A, do you believe CRR is a tool that one must be resorted to right now given the liquidity concerns? Or is this the rarest of the rare times when that tool should be used? And B, as someone who also tracks, the investment trajectory very closely, is this going to at all move the needle on private investment, even if rates were to come down by 25 basis points or 50 basis points? Do you believe the needle on private consumption and thereby private investment be moved at all?
The banking system liquidity is now about 30,000 crore short. It was at about 1,50,000 crore short in September 2018. So to that extent, case of CRR cut becomes weaker in Jan 19 as it was far more stronger in September 2018. But the point is that CRR also drags banks' profitability, and keeping in mind the persisting shortage of liquidity and with a view to give boost to banking profitability, one can consider a CRR cut, or one can consider accelerated open market operation. My preference is towards open market operation because it also puts a cap on the yield, and we have seen 10-year yield declining from 8.18% to 7.5%. The second thing about US FOMC I just want to bring to attention, the 11-year spread between 10-year US yield and India 10-year yield is roughly about 4.18%. And today we are on a new 10-year government security more than 4.58%. So effectively, if there is even 0.25% policy repo rate cut and 10-year yield goes towards even 7%, we will still be maintaining our historical spread over US Treasury yield. The third thing about investment, we believe for revival of investments, multiple factors are required. Interest rates and liquidity is just one of them. Of course, in absence of lower real interest rates and high liquidity, investments cannot revive. But mere availability of lower real interest rates and high liquidity alone will not push investments higher. Fortunately for India today, capacity utilization has started improving. In many industry like steel, bad assets have moved to stronger hands, and they are looking to expand capacity through brownfield expansion. If at this point of time we can provide them lower real interest rates, because if Government of India itself is paying 4% real interest rates, what will be the cost to private entrepreneur is imaginable. So lower real interest rates and higher liquidity will definitely infuse investments in view of other enabling factors like higher capacity utilization.
Yeah. Shaugat, I think Nilesh really nails it when he says that lower real interest rates, because just for the benefit of our viewers here, just to point out, inflation adjusted interest rates are already highest in Asia, and real rate rose to 4.31%. I mean, that's how the rates are. But so taking off from where Nilesh left and really going back in time, there was a period about 1.5 years back when inflation was benign, growth was slow, and the RBI kept saying, we will look at more data. This is going to be a data-driven decision. That decision kept getting delayed till the tide turned once again, and there was sudden uncertainty, and oil prices went up, and nobody thought that oil prices will climb so high. Can we afford a rerun of that now? Because the RBI has missed the bus once. Can we afford to let the RBI miss the bus one more time?
No, I think you're right, because right as of now, I think the difference between 2 years back and now is, I think, despite capacity utilization in certain segments beginning to go up, as the RBI data shows, I think we had just begun to see a revival of investment, if not large new investments, at least, I mean, in a bunch of sectors, in engineering, in pumps, valves, bearings, abrasives, I mean, you name it, driven by highway construction, driven by automotive industries, etc. We had begun to see a revival of investment. Steel, cement were beginning to see capacity shrink. So given this environment where investment was just about beginning to revive, and now there are signs, particularly from the credit side, that there are signs of a slowdown coming in. I think the Reserve Bank of India, together with the Government of India, must use all policy levers to try to keep growth going at about 7.5%. We can't afford to slow down beyond this. But in this environment, whatever the real interest rates are, I would think that liquidity is the primary tool that the policy authorities must deploy now. Whether it be through a CRR cut, which I do not think will happen, but essentially use OMOs. And OMOs, other than liquidity, also has the desired effect of cleaning out some of the illiquid securities sitting in banks' books. So and OMOs can actually target yields at certain points. So I think 1 lakh, 1.5 lakh crores of additional OMOs probably will set the spread that we are now seeing between the 10-year and, as Nilesh mentioned, the corporate bond spreads, which have also risen and which have maintained, I mean, which have gone up beyond the GSEC yields. I think all of these interest curves, I think liquidity infusion, particularly via OMOs, I think is a critical factor at this point in time.
Give me a minute right now, and I will take this across to Professor Nagaraj, because I think we've had a lot of discussion on the headline number of inflation and investments and all of that. I agree that there's been a considerable disinflation as far as food inflation is concerned, but look at core inflation. It continues to move with an upward bias. It continues to be extremely sticky at 5.8%. And wouldn't that be a decision that will perhaps, cast a no as far as rate cut is concerned? 5.8% for core inflation, which is not food, non-fuel, is very high. And food inflation, just to point out to our viewers here, food inflation being down is not a function of the RBI policy in any case. Professor Nagaraj?
Yeah. No, I think I'm not particularly concerned about the core inflation, because in India historically inflation is basically food and fuel, okay, and which is excluded in the core inflation estimation. So I really do not know what the core inflation really would tell us, because today if you look at core inflation, they're talking about educational costs, okay. And I don't know how important is that for in the CPI. Therefore, I would think that we should be more bothered about the CPI index and not too much about the core inflation. I mean, that's my reading. Core inflation in advanced countries where food and fuel do not matter very much makes a lot more sense. But in India, I think we should be more focused on food and fuel, which is captured in the CPI.
Okay. Just give me a minute. Pradeep Chaudhary, I'll quickly come to you. And while we are still debating a cut or no cut, what about the stance? And the stance has been calibrated tightening, despite the data being, in contrast to the stance the RBI and the MPC refused to change it last time around, even though I think that was a split vote really, as far as that is concerned. But what would you say? I mean, forget about anything else. Does the stance need to change to begin with? Because the stance is also it's a function of the RBI's signal. It's a function of where the monetary policy in India is headed, the trajectory and all of that. Calibrated tightening at a time when you have inflation readings of 2.19%, wholesale being 3.8%, IIP slumping to below 1% growth.
I think the stance is guided by the dogma RBI is following. Now, this CPI, earlier when the RBI started tightening, the ground given was that the food prices have shot up, it hits the poorest, so we must protect. Well, all that is accepted. Now, when the cycle is in reverse, why do you shift the goalpost and change the criteria? So, we have, I think, brought ourselves down to an IIP number of 0.5%. I think this is self-inflicted pain. And today, in agriculture sector particularly, in fact, low prices are the bane of the farmers, and as the recent assembly elections have also shown, that the rural sector is in huge distress because of low prices. And at this time, where do you see the ghost of inflation? Now, if we keep seeing this, and as I borrow your phraseology, that we will keep missing the bus, one bus after another will go, and we'll never board it. So it is time to think that we must join, and we must not join, we must lead the world. And look at China. Even China is worried about the drop in the production and the IIP numbers, so they are cutting interest rates. And today government has taken a good step that they have raised the customs duty on many products, which gives some protection to Indian industry and Indian businesses from imports. So at this time it is necessary to make everything available to restore the competitiveness of the economy. If you see the rupee parity, I think that's a telling commentary on the lack of or this decline in the competitiveness of the economy. So RBI's policy should not be just centered on one thing, and even if you are centered on one thing, be consistent, be steady on that. So you keep shifting and you look for the some negative points which would rationalize the decision to not lower the interest rate. So if you look for those kind of evidences, you will always find. If not, it is CPI, and it will be core inflation. Now, if CPI is not material, if core inflation is material, why is the salary structure of civil servants and entire public sector linked to CPI? Because it has been said time and again that CPI is the more accurate indicator of the real life prices in the market. So be that as it may, so let us follow that, and let us not shift the criteria just because we have decided to do something and we are conjuring up the reasons why we are doing something. So in fact it should be led by the development, led by data. And data, IIP at 0.5, I don't know how much worse it can get.
Right, right. No, absolutely. 0.5 is a dismal number, but remember this also came on the back of NBFC crunch and all of that. A quick last question, and I think Nilesh, let me just quickly come to you on this. And I think the question has to be, the data is going to point in one direction. And of course, there will be factors that is going to determine this. Perhaps some amount of ease is going to boost consumption, perhaps even move the needle on investments and all of that. But remember, in 2008, 2009, when all of that was happening, there was an easy monetary policy and a loose fiscal policy. Can we, can one judiciously ask for an easy monetary policy given the fact that elections are right around the corner? This is going to be a high stake battle. There is plenty of speculation that could, could there be SOPs in this election or even before that for the agrarian sector and all of this? How crucial will all of this be to decision making? Because all of these factors, if not anything else, forget the politics, add to a lot of uncertainty in the economic landscape.
Undoubtedly, market as well as RBI will keep a watch on fiscal discipline, and the finance minister has kept on reminding or assuring market and RBI that they will manage this year's fiscal deficit. The good part about India is that we might be liquidity poor, but we are asset rich, and if government funds their extra spending through divestment, through monetization of their assets, then to that extent fiscal discipline can still be maintained, and that discipline on fiscal side could give the leeway to RBI to provide easy monetary policy. The fact remains that now we have brought down from double-digit inflation to mid-single digit to lower single digit, and correspondingly there should be decline in interest rate so that entrepreneurs get real interest rates which are reasonable, they don't overburden them, and then they can go on the spree of investment.
Right, right. Okay, completely out of time on this edition of the show. I think the panel is unanimous as far as a rate cut is concerned. Many people believe inflation reading and of course the commensurate reading that's coming in from the growth space, which is the IIP, is all pointing in the direction of a rate cut, is perhaps paving the ground for this. But I think the RBI and the Monetary Policy Committee is going to very strongly and keenly watch what the Finance Minister does announce in his interim budget on the 1st of February, because fiscal prudence or fiscal profligacy is actually going to determine which way India's monetary policy really moves. But for now, it looks like a rate cut is very much on the anvil, and for once the discussion on RBI has moved away from the board tensions and NBFC liquidity crunch and all of that to where it really belongs, and that is the rate cut. Thank you very much, Nilesh Shah, Mr. Pradeep Chaudhary, Professor Nagaraj, and of course Shagata Bhattacharya for being with me. We take a quick breather, but up next is Top 10 at 10.